Half of CFA candidates get these wrong. Not because they're hard, but because they misread what actually drives prices and margins. Let's break down the impact of competitive factors in prices and cost questions you cannot afford to miss. Question 6. Based solely on this analysis, the analyst should conclude that aerodynamics' ability to negotiate lower prices from its suppliers is high. B. Maintain high profit margins is low. C. Pass on increased costs to its customers is high. Correct answer, C. Few alternatives. The parts are super important for safety, and there aren't many other options out there. This means aircraft manufacturers can't just switch to something else easily, which gives aerodynamics a big advantage when it comes to pricing. For instance, if aerodynamics needs to hike prices because of more expensive raw materials, customers probably won't complain too much. After all, swapping out these parts would put safety at risk and cost a lot to fix. Limited power for buyers. Even though customers are big and have long-term deals, the special nature of the parts and how important they are mean they don't have much of an edge. Aerodynamics can say that price increases are needed to keep things safe and high quality, and customers probably can't argue with that. Aerodynamics holds a significant 55% market share, which gives it a commanding position and less need to keep prices low to stay competitive. The high capital needed and strict regulations make it tough for new companies to join the market, which means there won't be as much competition in the future. It seems like aerodynamics can easily pass on the extra cost to its customers. Because of its strong market position, the lack of alternatives, and the importance of its product, aerodynamics can shift the cost pressures onto its customers while still making a profit. A. Incorrect. Aerodynamics faces limited bargaining power with specialized alloy suppliers. B. Incorrect. Aerodynamics benefits from a favorable environment for sustained profitability due to low substitutes, weak buyer power, and high entry barriers. Question 5. Based on this competitive landscape, circuit cores operating profit margins over the next 3 to 5 years are most likely to A. Decrease due to pressure from powerful buyers. B. Remain stable or increase. C. Be highly volatile and unpredictable. Correct answer, B. Circuit core is in a great spot because the market is pretty good for them, with all the forces working together to keep things profitable. Not a lot of competition. They're the biggest player with 65% of the market, compared to 12% and 8% for the others, which means they can set prices pretty high without worrying about losing money. It's hard for new companies to get in. The big costs to build factories make it tough for anyone else to join, so they're likely to stay in the lead for a long time. Buyers with limited negotiating power. Custom chips with high switching costs often mean buyers have to accept price hikes instead of redesigning their systems. Suppliers with limited negotiating power. Circuit core can negotiate good terms with globally sourced silicon wafers, which helps protect their margins from changes in input costs. No substitutes. Circuit core's unmatched performance means customers don't have any other options, which makes it harder for competitors to challenge them. A. Incorrect. High switching costs and customized products weaken buyer leverage. C. Incorrect. Stable, protected industry structure unlikely to change. Question 4. An analyst is studying data flow systems, a provider of specialized data analytics software for financial institutions. The software is highly integrated into clients' operations, making switching costs very high. The market is concentrated, with data flow and one other major competitor holding 80% of the market share. Recently, several cloud-based platforms have started offering basic, standardized analytics tools that, while less powerful, meet the fundamental needs of some smaller financial firms at a fraction of the cost. According to Porter's 5 forces, which force now poses the most significant threat to data flow's ability to maintain its premium pricing? E. Bargaining power of buyers. B. Threat of new entrants. C. Threat of substitutes. Correct answer, C. The substitute threat. Cloud-based platforms provide simple, standard analytics tools that smaller financial firms need, all for much less than Dataflow's specialized software. These alternatives aren't direct competitors because they don't have the same advanced features or easy integration, but they're a good option for customers who are looking to save money. This makes it harder for Dataflow to keep its prices high. Pricing power and data flow. Dataflow's main clients, which are the bigger financial institutions, have a tough time switching to other providers because of the high costs involved. This makes it hard for them to find alternatives. But smaller companies, which are becoming more common, might choose the cheaper and easier options instead. If Dataflow doesn't lower its prices, it could lose these smaller clients to other providers. This might mean a smaller profit margin because fewer customers are using the service at higher prices, compared to more customers using it at lower prices. A. Incorrect. High switching costs for Dataflow's integrated software limit buyer power, with pressure primarily from substitutes. B. Incorrect. Cloud platforms offer substitutes for a subset of Dataflow's customers, but direct competition in the premium segment remains limited. When cheaper alternatives appear, it can change how the industry works. Dataflow needs to figure out if they should keep their high prices and risk losing some of their smaller customers, or lower their prices to try and compete, which might hurt their profits. This choice shows how important it is for substitutes to be a big concern. Question 3. An analyst is evaluating the performance of precision manufacturing company and chooses to use return on invested capital, ROIC, as her primary metric. A junior analyst asks what this metric specifically measures in its calculation. The return on invested capital metric incorporates the company's after-tax interest expense relative to its total debt. B. The efficiency of using operating assets, net of non-interest-bearing operating liabilities. C. The company's net income generation relative to its total shareholder equity. Correct answer, B. Return on invested capital, ROIC, tells us how well a company is using its money to make a profit. To figure it out, we look at the company's operating assets, like equipment and buildings, and subtract its non-interest-bearing operating liabilities, like what it owes to suppliers and expenses that haven't been paid yet. ROIC is calculated as ROIC equals net operating profit after tax, not but operating assets, operating liabilities. It's all about figuring out if a company is making enough money from its main business activities, compared to how much money is put into those activities. A high ROIC means the company is using its money well, which can be a sign that it's doing better than its competitors. Here's how return on invested capital, ROIC, is different from other things. ROIC looks at how well the company is doing in its core business. ROE looks at how much money the company makes for its shareholders after the company has taken care of its debts. Interest coverage ratios focus on how well the company can pay off its debts. A. Incorrect. ROIC focuses on operating profit, excluding interest expense, unlike interest coverage ratios or WACC components. C. Incorrect. ROE measures returns to shareholders, while ROIC measures returns to all capital providers. Question 2. Biogen Innovations has just launched a novel gene therapy treatment. The company expects competing therapies using similar technology to reach the market in 2 years. The company also states that significant ongoing research costs will be required to maintain its technological edge. Based on Biogen's expectations, the gross profit margin of its gene therapy division in 2 years is most likely to be affected by a competition from new market entrants, B. High research and development expenses, C. Regulatory compliance costs. Correct answer, A. Gross profit margin is calculated as revenue minus cost of goods sold, or COGS, divided by revenue. Think of it as a way to see how much money you're making from your main business activities, like making and selling products, before you think about other expenses like R&D, general and administrative costs, and any regulations. When you're under pressure from competitors, you might see your revenue drop, or you might have to cut costs, which can all affect your gross margin. Biogen anticipates that other therapies will be available in about 2 years. This competition could lead to more options, which might lower prices if the products are similar. Alternatively, Biogen might need to offer discounts to keep customers. If prices drop without cutting costs, Biogen's profit margin could shrink. Gross margin looks at how well production is running, how much revenue comes in compared to direct costs. Operating margin considers R&D, general and administrative expenses, and regulatory costs, giving a broader view of overall efficiency. Biogen's situation shows how competition can affect prices, which is a key factor in gross margin, while R&D and regulatory costs are more important than operating margin. Correct answer, B. Return on invested capital, ROIC, tells us how well a company is using its money to make a profit. To figure it out, we look at the company's operating assets, like equipment and buildings, and subtract its non-interest-bearing operating liabilities, like what it owes to suppliers and expenses that haven't been paid yet. ROIC is calculated as ROIC equals net operating profit after tax, not but operating assets, operating liabilities. Question 1. According to Michael Porter's framework, how should an analyst incorporate the impact of new environmental regulations into an industry analysis? A. Treat the regulations as a distinct sixth competitive force. B. Assess how the regulations alter the existing 5 competitive forces. C. Disregard the regulations as they apply equally to all industry participants. Correct answer, B. Porter's framework doesn't see government as a separate competitor, because its impact is indirect and can change. It can either boost or hinder the 5 forces that already exist, depending on what the government does. For instance, if the government sets up environmental rules, it might make it harder for new companies to get in, which affects the threat of new competitors or make it more expensive for suppliers to work with them, which changes how much power suppliers have. But these rules aren't a separate, all-encompassing force. Let's take a look at how new regulations might shake up each of the 5 forces. Threat of new entrants. Imagine stricter rules, like those for emissions. They could make it more expensive to follow them, which might keep new companies from jumping in. Bargaining power of suppliers. If regulations push suppliers to use more expensive methods, it could give buyers more of an edge, especially if there are other options available. Bargaining power of buyers. If regulations push prices up, like with carbon taxes, buyers might ask for better deals or look for different products. Potential for substitutes. New rules might make current products less appealing, which could encourage people to switch to alternatives. Industry competition. If smaller companies find it hard to keep up with the costs of following the rules, they might have to merge or face less competition. A. Incorrect. Porter's framework rejects treating regulations as a sixth force, viewing government influence as a modifier of existing dynamics. C. Incorrect. Regulations impact participants differently, reshaping competitive advantage.